Alright, so today's video is going to be very different from my usual videos, but we'll see how it goes. I thought I'd try something new, right? So today's video is going to be, well, you already know what it's going to be, right? Because it's in the title and the thumbnail. Anyway, what is a better investment? Stocks and shares or buy-to-let properties? And this is a question that I'm asked all the time, so I thought, why not just make a video on it and save myself from having to repeat it over and over again. But just before we get into the video, my name is Hakeem. I'm a chartered accountant and I post videos on all things finance and investing. So if you like today's video, maybe you'll like the other videos I post as well, in which case you should hit that big red subscribe button down below. Anyway, back to the topic at hand. So I want you to think about this in 4 sections. The first is how much work is required. Ultimately, right, when people are thinking about investing in stocks, it's a relatively passive thing to do, depending on how active of an investor you want to be, but we can get onto that later. Whereas when people think about getting into property, they usually see that as more of an active investment, although the amount of people that underestimate the amount of work that can be required is astonishing, but again, topic for another day. And obviously there are steps that you can take to reduce your own personal time requirement in property as well, and we'll get onto that. The second is the capital requirement, right? So in other words, how much money do you need to start? Number 3 is risk, and I don't think I need to explain what that means, but obviously we'll get into the specifics of that. And the last but definitely not least is return on investment. Now, obviously, given the fact that this is a video for the public and is not bespoke in any way, there's going to be a lot of generalizing, but actually that's typically not a bad thing with these kind of analyses. Alright, so number 1 is time requirement, and there's already a million variables that will dictate how much time you spend on each of these investment strategies. In property, your returns will almost always be higher if you buy, say, a rundown property, spend the time renovating it, and then rent it out. Your returns will be even higher than that if you then choose to manage the property yourself, rather than pay an estate agent or managing agency who typically take as much as 10% of gross rental income. But for a lot of people, that's a price worth paying to save the nightmare of being woken up by your tenant at 4 AM in the morning because they've locked themselves out of the house because they're too drunk to realise that they have to take their key with them when they leave the house. Oddly specific, I know. Now, you compare that with stocks, where the vast majority of investors are just going to buy an index fund, and the extent of research required is understanding what broker they're going to use or how to set up a direct debit for their investments. So pretty much nothing. Literally all you have to do is set up a direct debit to invest every month, forget about it, and wake up a hell of a lot richer in 30 years' time. Index fund set and forget investing is the definition, literally the epitome of passive investing. With that being said, if you do fancy yourself as a bit of a modern day Warren Buffett, you might try and pick individual stocks to outperform the market. Now, if you want to be fully diversified, and you should want that, you need somewhere in the region of 20 stocks, depending on who you ask, in your portfolio across a range of different sectors. Assuming you do the bare minimum, which is to run through their earnings reports every quarter, which might take you, say, 2 hours per report, we're talking about 40 hours every 3 months. And obviously that's not even taken into consideration looking for new opportunities, which typically takes a lot longer. So there definitely is a bit of work required. Long story short though, is that stocks are most likely going to be a hell of a lot more passive than having a buy-to-let property. So consideration number 2 is the capital requirement, right? How much money do you need to get started? Well, with stocks and shares, it's an easy answer. It's literally as little money as you want it to be. And with the rise of fractional shares, there's no longer restrictions placed on investors with very little starting amounts of money. So that's obviously great. The answer is obviously very different for property. So generally speaking, you'll need a 25% deposit or down payment, at least in the UK, against the total value of the property that you're looking to buy. So let's say you want to buy a 2-bedroom house in a relatively low cost of living area, far away from London. That might cost you £150,000, and these are just numbers I'm plucking out here, right? Obviously, in some areas it could be much higher, and in others, typically the further north you go, it could be much lower than that. But for the sake of an example, let's call it 150. A 25% deposit on that is 37.5 grand. You've then got stamp duty, which is just a form of tax payable when you buy a property, of 5k. Assuming you own a property already, it's slightly different if you don't. You then have solicitors' fees of somewhere in the region of £1,500. So we're looking at, about £45,000 of capital in this particular example. Of course, it could be more or less. For example, you might have bought a property that needs some work doing, so you might think about setting aside another 10 grand to do that, depending on how handy you are and what needs to be done. By the same token, you might have bought in a cheaper area or something that needs a lot more work doing, which tends to save you money as well. But I think a rough guide of around 45 grand is actually quite reasonable. So clearly that's a lot of money, and the majority of people don't tend to hold that much cash. But if you are a homeowner already, and you have been for a while, There's always the option to use some of the equity that you've built up in your main residence by remortgaging, extracting that capital and using that as a way of building out your property portfolio. But I think it's safe to say that stocks and shares is the clear winner for consideration number 2 in terms of ease of access. Now, the third point is potentially the most difficult one to predict, which is risk, as there's so many variables that come into play, right? So starting with stocks and shares, if you're investing in a broad index fund covering many geographies and potentially thousands of equities with a time horizon of, let's say, at least 10 years, I would argue that the risk of losing capital is very low. For example, the average annual return of the S&P 500 over the last 100 years with dividends reinvested is around 9% a year. Although the actual return in any given year is hardly ever 9% actually. You tend to have much higher performing years offset by much lower performing years. And that will be illustrated by the graph on the screen right now. Another thing that's evident straight away is that there are far more green years than there are red years. And in fact, the S&P 500 has ended in the green roughly 75% of all years. Even in the times where we've seen declines of 40% or more, which is absolutely huge in a single year, the average time to recover was about 5 years. So generally speaking, over a 10-year time horizon, you'd be incredibly unfortunate to lose money. Now, with that being said, if we're talking about investing in individual stocks, that is a hell of a lot more risky, and people probably don't actually recognize how much more risky that is. And as we've seen over the last couple of years, a stock could fall by 90% or more in a single year and potentially never recover. So the risks to your total capital when investing in individual stocks is genuinely the full amount of capital that you put into them. Companies do die, and along with that company goes the capital that you invested. Now, with a buy-to-let property, it's a lot more nuanced because now you have to consider the fact that you're using leverage. In other words, you're using debt, which is inherently more risky, particularly if we experience a rapid rise in interest rates, which is obviously something that people are very concerned about at the moment, albeit interest rates are still incredibly low right now. Or, for example, the drastic scenario in which house prices crash entirely, resulting in you falling into negative equity in the property, which is where the amount of money you owe to the bank on the mortgage is larger than the value that you possess within the property. And if that happens, somebody from the bank will come knocking and say, "We're not happy with the amount of risk that we have in this deal, you're going to have to sell the house. And by the way, you'll have to use your own cash to foot the difference between what you owe us and how much you can get for the house." Now, obviously that's an extreme circumstance, and the chance of that happening is incredibly low because you've put a 25% deposit into the house. Now, 15 years ago, before the global financial crash, people were getting 100% mortgages. So from day one, they had no equity in the property whatsoever. And as soon as that bubble began to burst, you get this snowball effect in full flow where there's a huge rush to sell property, pushing prices even further down. Now, thankfully, we don't have that going on anymore. With property, you also have to think about the risk of tenants not paying you, whereby you have to go through a lengthy legal process just to get your house back, or periods where you simply don't have a tenant, so you don't have the income, but you still have the ongoing costs, right? So money's going out of your bank when no money is coming in. And of course, on top of that, you've got potential issues with the house itself. Maybe you need to spend thousands getting the roof repaired or something like that. Now, if you run your buy-to-let property smartly and run it like a business, as you should, you'll set aside provisions, say a percentage of that monthly rental income for these kinds of expenses, so that when they do arise, you have the money to pay for them. So in terms of consideration 3, it's difficult to say which is riskier between stocks and buy-to-let due to the many variables involved. But if we're talking strictly about index fund investing versus buy-to-let investing, I would argue that the buy-to-let, so property, is more risky due to the leverage involved. So that brings us to point number 4, which is arguably the most important consideration of all, which is the return on investment. How much can we expect to make through these different investment strategies? Now, I want to keep this relatively straightforward whilst including enough detail so that it's not inaccurate, right? But we'll see how this goes. So let's imagine we buy a property somewhere in the north for £100,000. That's an initial cash outlay of £29,000, being a £25,000 deposit, 3k in stamp duty and 1k in solicitors fees. Now, the property needs a little bit of work doing to it, and we want to benefit from the increased equity driven by a renovation. So we spend an additional £16,000 on bringing the property to a decent condition, resulting in a total investment of £45,000. Now, after that £16,000 of renovation work, the house is now worth £130,000. The average rental yield on properties in the UK outside of London is around 4%. So we might expect annual rental income of about £5,200, which is actually a 4.5% yield on our initial investment because, of course, we've got the benefit from the increased value in the house following the renovation. Now, in terms of costs, we can get an interest-only mortgage on the £75,000 borrowed at 2.4% fixed for 5 years with an upfront fee of £1,300. Now, I'm going to ignore the upfront fee for now, just for simplicity. That's a monthly repayment of £150 or £1,800 a year. Now, given that we've bought the house somewhere out in the north, right, to reduce the total outlay, we need someone to manage the property for us, and a lettings management agency is willing to do that for 10% of the total rent, so that's £520 a year. A general estimate for maintenance costs is around 1% of the total value of the property per year, so that's a further £1,300 a year, leaving a total profit of £1,580 a year. But remember, this is before the taxman has taken his cut. And this is where I usually see incorrect calculations on how much tax will be paid. Most people just assume that the tax will be 20 or 40% of the total profit, depending on whether the person is a basic or higher rate taxpayer. But actually, since April 2020, interest expenses on mortgages are no longer tax deductible. And instead, landlords can receive a 20% tax credit on the amount of interest that they pay. So to calculate your taxable profit, you actually have to add back your total interest payments, meaning the taxable profit is actually £3,380. Now, assuming the individual is a basic rate taxpayer, that leaves tax of £676, which we can then deduct our interest payment tax credit of £360, meaning the total tax payable is £316 a year, and a profit after tax of £1,264. Okay, hopefully you're still with me. Now, to keep things simple, we'll assume that our rental profits increase by 2% every year. Of course, the rental income itself will probably increase by something closer to 4%, but remember that many of the costs are directly linked with the level of income. So as your rental income increases, your costs will also increase, which is why we're only increasing our profits by 2% a year. By the end of the 25 years, we would have made £40,000 of profit. On top of that, if we assume that the house appreciates by 4% a year in value, which is broadly in line with the previous 10 years, it will be worth almost £350,000 after 25 years. Remember that the mortgage was an interest-only mortgage though, so we need to give the bank their £75,000 back, leaving us with £272,000 of equity in the house. So the total value we've got from the house is £312,000 over 25 years. But once again, we need to remember that the taxman wants his cut on the capital gain if we were to sell the house, which would be a rate of 18% in this instance on the increase, or almost £40,000. Now, granted, a lot of people don't take this into account, the capital gain, as they never intend on selling the property and instead will pass it down to their loved ones when they go. But that would still be subject to inheritance tax of 40% on any of the estate over £325,000. So it's definitely important to think about. That means we've turned that £45,000 investment into £273 of value in our pockets. Alright, so that was a little long-winded, but you'll be pleased to know that stocks are a lot more straightforward. So we're going to take that same £45,000 and in year one, we're going to put £20,000 into an index fund in a tax-free ISA. Now the reason it's £20,000 is because that's the maximum deposit limit per year into an ISA. The remaining £25,000 is going to go into the same index fund, but this time in a standard taxable investment account, and we're going to drip that into the ISA over the next 2 tax years. Everyone gets a tax-free capital gain allowance of £12,300 of profit a year, so there's no concerns of paying taxes on the general account either, as our profit on that £25,000 will be under the threshold. So the following year we add another £20,000, and the third year we add the final £5,000 plus whatever gains we've made in that time. Now, if we assume the index fund that we've invested in returns an average compounded annual growth rate of 9%, the investor will have £383,000 after 25 years. There's no tax to pay because it's in a tax-free ISA, therefore the total gain is £338,000 versus the £228,000 gain from the buy-to-let property. So despite it being a lot less work, the stocks come out on top in this particular scenario. It's worth noting though that people tend not to stop at just one property, right? So they use the equity that they've built in one property to buy another, and then the equity from that property to then buy another, and so on. So you really do get that snowball effect of growing your portfolio. Now, using that method allows investors to supercharge their gains using even more leverage, and these types of investors often see returns much greater than those achieved in the stock market, or at least they have historically. but of course the risk is also greater too. The point I'm trying to make is that there are so many different variables that can come into these kind of comparisons that the individual has to work out what would be best for them. Some people will be better off in stocks, there's no doubt about that. Others will be better off in property. But if there's one thing that we can all agree on, it's that some form of long-term investing is almost always better than leaving your cash to slowly burn in the bank through inflation. Thank you for watching. Don't forget to like and subscribe, and I'll see you in the next one.